So I just want to spend a few minutes to go over the types of differences that can occur between financial income and taxable income. You should have already walked through the videos for deferred tax liability and deferred tax assets. Here's where I want to kind of provide a little summation for that. You can have differences between taxable income and financial income that are temporary or that are permanent. What we dealt with deferred tax assets and deferred tax liabilities were temporary differences. Temporary differences will do one of two things. They will result in future deductible amounts or future taxable amounts. Future deductible amounts such as product warranty liabilities. From a financial perspective, we're going to recognize warranty expense in the year of the sale of the product that's being warrantied. IRS doesn't allow you to deduct those items until you actually pay for them. So that's going to be a future deductible amount, which will yield a deferred tax asset. Subscriptions received in advance is another example of that. That's the example that we walked through for our deferred tax asset. And then unearned rent revenue. From a financial perspective, we will wait and recognize that rent when we've actually earned it, but from a tax perspective, we will recognize it when we collect it, which means later on there will be a tax benefit. Then there are temporary differences that result in future taxable amounts, and these are what lead to the deferred tax liability we talked about. That can be the difference between a book basis and tax basis for prepaid insurance. A really common one is excess tax depreciation over book depreciation. Those of you who have already taken tax know that for your tax return you use maker's depreciation, which is an accelerated form of depreciation. What that means is you will have more expense in the early years under tax than under financial reporting. When that reverses in the future, you're going to have higher taxable income and therefore higher taxes. So these are all temporary differences. They are timing differences. It is not that you will report something as income for financial statement and never report it for taxes. It's merely a situation wherein they will happen in different years, and they will lead to a deferred tax asset or a deferred tax liability. Now, in contrast to that, permanent differences are items that you recognize as income or expenses in your financial statement perhaps, but you will never recognize them on your tax return. They will not lead to a deferred tax asset or a deferred tax liability because there is no deferral. It is just different. Examples of these: interest received on state municipal obligations. If you have a municipal bond, let's say you buy a bond from the city of New York, you will receive interest on that. You will never be taxed on it. The federal government has said we will not tax income from city or state bonds. This is a way of giving cities and states a break, if you will, in terms of the interest rate that they have to pay. Because if I don't have to pay if I don't have to pay tax on the interest I receive from that, I will accept a lower interest rate, which is a break for the city or state. Secondly, if I as a company, pay premiums on a life insurance policy for the CEO, this is not uncommon, wherein the company is the beneficiary. Those premiums are never going to be deductible. But there's a reason for that, and that is if that officer, that CEO, passes away and the insurance policy pays, the payment is not taxable income either. So neither will the payout be taxable, but as a result, neither will the premiums be deductible. There is a deduction for certain qualified dividends that you receive. This on stock, on U.S. stock, this is a way of addressing for corporations the double taxation issue. The situation that arises because a corporation is taxed on their income, they pay it to their stockholders in dividends, and then the stockholders are taxed. So there is a deduction for that. That is a permanent difference. It's not that you're going to be taxed at a different time. You're never going to be taxed. And then lastly, fines and expenses that you have because you have violated a law are never deductible. In other words, you're not going to be able to pollute the river, pay a fine for that, and then take a deduction for it. So these are permanent differences that will never be flowing through your tax return. As such, there will be no deferred tax asset or deferred tax liability. It's important to understand the differences between those. And I refer you to your textbook because there are a couple of schedules in your textbook that actually provide more detail in terms of examples of these.